going to move on to another paper on the relationship between cross-sectional predictors and market returns. It's a really interesting idea. Can you talk about the difference between a cross-sectional return predictor and a time series return predictor?
Okay, so this is a little bit more technical, but here's how I would kind of broadly explain this. Think about what we were just discussing, equity lending fees. So my other work looks at the cross-sectional aspect of equity lending fees. Stocks with high equity lending fees tend to do worse than stocks that have low equity lending fees. And when I say cross-section, I mean at a point in time, if you just kind of look at the cross-section of stocks, that's the result you see. So cross-sectional predictors are the ones that predict the cross-section at one point in time. There's a whole different category of return predictability that we call time series. And this is where we're looking not at one point in time, but over time. And so what we do in some of my work is we try to look at basically when do cross-sectional predictors contain information, and do they contain the same information as the time series predictors?
And so how are they linked, the cross-sectional and time series predictors?
Again, it's a little bit technical, but this is one of the things we really look at carefully in the paper, is that it turns out cross-sectional predictability and time series predictability can be linked, but they don't have to be. And the way I'll kind of explain it is, again, go back to my equity lending fee example. Stocks with high loan fees predictably earn lower future returns. It is possible that it is the idiosyncratic, the firm-specific piece of the return that I am predicting in that example. If that's the case, then when you add up all this information across every stock in the economy, there's going to be no return predictability for the overall time series. Why? Because if you're predicting just the firm-specific piece, some firms every quarter have positive news, some firms have negative news, and when you add them all up, they tend to cancel out. So what we show is basically the relation between the cross-section and the time series depends heavily on whether the cross-section is loading on the firm-specific return or if it's loading on the kind of market component.
That's a really nice way to explain it. I mean, it's the title of the paper that makes a lot of sense. So cross-sectional predictors, do they contain idiosyncratic or systematic information? If they contain systematic information, then they should be time series predictors as well.
Exactly. And that's exactly what we find.
Yeah, really cool. How did you choose the cross-sectional predictors to study in this research?
Well, in that paper, we basically started with just a general set of almost every cross-sectional predictor that had been discovered to date. Okay. So we took a database of basically 100 of these cross-sectional predictors from kind of leading academic papers.
And how did you organize them? Like the evaluation, opinion, existing literature?
Yeah, I mean, what we really wanted to do was to understand whether or not these cross-sectional predictors in general contained kind of market-wide systematic information. And so we started off by just looking at all of them. And what you kind of find, of course, if you look enough at data, by random chance, you're almost always going to find some pattern. And then the real question is that just dumb luck, or is that really actually illuminating some economic force? And so we looked at all of them. We found some seem to have something, some don't. What do we learn from that? And so then we started saying, okay, what if we could kind of organize these things into more, manageable subsets to try to see if things that had characteristics in common also had that same result. And so what we broadly looked at is we looked at all the valuation ones. Why look at those? These are, again, things that kind of have some ratio of market prices relative to fundamentals. Well, you might think that the fact that they have a market price in them suggests that there's some sort of systematic information. So we wanted to check just that group. And then we also looked at a couple of other groups. Kind of the opposite of the valuation group is to look at what I would call the opinion group. These are things like analyst upgrades, where it's just some analyst's opinion about the valuation of the stock. So we looked at kind of all of those as a group. And then the last thing we did is we took all of the cross-sectional predictors that had been shown to have the strongest return predictability, and we said, let's just focus on the best ones and see if the best ones contain information about time series predictability.
So how well do cross-sectional predictors tend to perform in predicting the time series of returns?
The punchline of this is not so well.
Yeah.
What we actually find is, again, there are some that work really, really darn well. But when you really look at kind of all 100 of these things, you find roughly about as many good ones as you'd expect by random chance. And so that's where I said again, one of the challenges, of course, whenever you look at a large amount of data, is that some patterns will show up just by dumb luck. And so we find that some of these things really do seem to have systematic information, but not very many of them.
And what adjustments do you need to make to account for data snooping?
Yeah, I think this is something that the academic literature has been thinking about more and more lately, and especially this whole literature on asset pricing anomalies and return predictability is how do you adjust for data snooping? And you mentioned Andrew Chen earlier. He and I have had some debates about this, and I think that the honest point is that the literature really hasn't converged on the proper way to do this yet. But what we do in our paper is we basically make an adjustment that corrects for the number of things we examined. And so that should actually make sure that that the data snooping bias from the fact that we snooped through a bunch of different variables is corrected.
Yeah. So do your findings basically say that if we take a cross-sectional predictor like price earnings or whatever, that it's probably not going to be great for predicting time series returns?
Yeah, I mean, I think one of the takeaways from the paper is that very few of these cross-sectional predictors contain systematic information. They seem to, if they are working, it's because they're loading on the idiosyncratic component of returns. And so most of them just, if you really wanted to use them for market return predictability, they're just not going to add much.
So I guess you just answered that, but what are the implications for investors who might be tempted to time the market with these?
Yeah, I mean, again, this is one kind of like your market efficiency question from earlier, where I feel like I'm going to give a wishy-washy answer that never really answers a question. In some sense, I think I'm skeptical of anyone who says I can strongly predict the market. Markets are incredibly competitive, and we know that, and so it's very, very hard to predict the market. So I think our results suggest very few of these things can be used to predict the market. That having been said, we do see some of them contain a little bit of information. And if you kind of pressed me, I generally do think it's possible that some of these things can help you, at least at the margin, improve your forecast of the market.
So you teach an introduction to investments course. I'm curious to know, what are the most important lessons that you try to leave your students with by the end of the course?
Yeah, I guess I'll say two related things. So the two things I kind of stress with my students. Thomas Sowell famously said there are no solutions, only trade-offs. And I think this is one of the ideas I really try to impart on every student I see. For most problems in the real world, you don't get to do some simple calculation and then get a nice answer like 42. Most problems involve trade-offs, and you've got to dig down and understand what the trade-offs are. And if you don't see the trade-offs and you don't understand the trade-offs, then you're not ready to make a decision. So that's kind of one of the key things I try to stress with everyone. But since I teach an investments course, I mean, the kind of closely related idea to that is I really hope everyone understands the risk-return trade-off. I think that's one of the most fundamental ideas in all of financial markets. And so at a high level, riskier choices require something extra to incentivize you so that you're willing to choose to take the risk. And I kind of hope everyone understands that. Certainly, I hope all of my students understand that.
Two great lessons.
Yeah, that's a great answer. Yeah. And I know you're talking about that with respect to, or in the context of investing mostly, but as Ben and I are financial planners as well. And I think it applies universally within to many fields, I'm sure, but as well, specifically with financial planning beyond investments. Great answer.
Yep.
Well, and I even joke with my students that in my household, I'm not even allowed to do the grocery shopping anymore, because if you send me to the grocery store, I sit there and think risk-return trade-off for every item on the shelf. And it ends up taking me hours to even, pick out a simple grocery cart full of stuff. But
that's pretty funny.
But I do think the risk-return trade-off is a very powerful and important idea.
Yeah.
Mm-hmm. Yeah, absolutely.